Because I think it's not the start of a new aggressive rate cutting cycle. I think it is the end of the aggressive tightening cycle. And the Fed overshot quite deliberately in its tightening, and it's now feeling comfortable enough that it can bring rates back to something closer to a normal level. Yeah, so I think it's not the excitableness from the bond markets that want rates to be constantly cut so that you keep buying bonds. So yeah, I'm viewing it more as a normalisation rather than the start of a stimulus cycle. This is just taking kind of your foot off the brake rather than stamping on the accelerator.
Yeah, and in the post-decision press conference, Chairman Powell did indicate that as well, Mark. He said that we are not going back to the world of ultra-low interest rates and that the economy is in good shape and that investors should not assume this is the new pace. Now, what does that mean for where this rate easing cycle ends in terms of the terminal rate expectations by the market? Because I think that's circling anywhere, if you go by the dot plot, between 3.5%.
Well, it is quite interesting, isn't it, that all these central banks, they put out these dot plots or these graphs showing the great uncertainty even amongst the people at the central banks. And yet people who are trying to predict what the central banks are going to do seem to have greater certainty than the central bankers themselves. Equally, I'd just be very wary of the Fed futures. People look at those Fed futures probabilities of cuts and get very excited. The market is predicting this and it's predicting. It isn't. The probability of rates being cut to 400 basis points by now, this time a year ago, went from 5% to 60% and then back to 3% in the space of about 3 months. So there's a lot of market positioning going on here. A normal rate, personally, I would put it somewhere around 4. But that's where the bond market is already. So I think the most important message, I would say, for investors is actually this isn't about the US economy. This isn't about growth or inflation. It's about you're very heavily overweight dollar assets. And the return on the cash part of your dollar assets is coming down. And what are you going to do with your liquidity? And it's those liquidity moves, I think, that are going to be the most important feature of this cycle, if you want to call it that.